Good morning again, and welcome to SYGNUS Real Estate Finance Limited's earnings call for the financial year ended August 31, 2025. My name is Justine Powell. I'm a member of the investment management team at SYGNUS Capital, and I will be a moderator for today's session. SYGNUS Capital is the investment manager for SYGNUS Real Estate Finance. I want to thank you all for taking the time to join us today to hear more about SRF's performance for the financial year ended August 31, 2025, and to learn about the operations and the future plans for the business. Before we begin, I do want to remind everyone that the discussion today may include forward-looking statements that could cause our actual results to differ from expectations in the future. We encourage you, as usual, to review the audited financial statements and the management discussion and analysis that have been released, and these are available on the Jamaica Stock Exchange website, and by the end of the meeting they should also be available on the investor relations section of the SYGNUS Group's website. Now I'd like to introduce our presenters for today. So we have Mr. Jason Morris, Chief Investment Officer and Executive Vice President of SYGNUS Capital, and we have Mr. David Cummings, Vice President and Head of Real Estate and Project Finance at SYGNUS Capital. After Jason's remarks and David's remarks, we will open the floor for questions. As usual, we encourage everyone to participate by submitting their questions using the Q&A feature in the Teams platform, or you can send your questions via email at srf@sygnusgroup.com. So over to you, Jason.
Hi, thanks, Justine. Good morning, everyone. I want to really start this off by just acknowledging the devastating effects of Hurricane Melissa on Jamaica as a whole, but more primarily so on those in the western end of the island and somewhat in the middle of the island as well. It's really a very, I don't even know the word to use to describe it. The good thing is that, we have all been banding together to provide support to families and friends and extended families and extended friends. And, the support by the Jamaican people and our ability to really help each other is coming to the fore, and also all the help that we're getting as a country from those who live overseas, whether they are Jamaicans or non-Jamaicans. We need every single level of assistance that we can get, because the situation in some of the parishes that have been hit is really catastrophic. So I want to start off by acknowledging that and hope that everyone who's on this call will continue to provide support if you have already done so, or is looking towards providing some form of support. Like I said, from my perspective, and I'm from St. Elizabeth, with family in St. Elizabeth and Westmoreland, it's a pretty dire situation. So, getting past those somber thoughts and getting into the discussion for today proper, want to start out by highlighting the fact that during the just concluded financial year for SRF, we had quite a number of achievements. Just want to highlight four major things. Well, before I start highlighting the four major things, maybe what I should really say is that 2 years ago, I believe it was, when we would have indicated to shareholders that SRF would begin entering the last stages of its first investment life cycle, and this would overlap with the first part of its new investment life cycle, and that because of that, we would have, very clearly outlined a plan over the 2-year period, and part of that plan was that we would have, as the manager, reduced the management fees down from the normal 2% to 1% in the first year and to 1.25% in the second year. And that second year is what would have ended August 2025, right? And would have stated that during that period, deployment of capital would have been reduced substantially, while we would have been exits would increase. And then as we entered into the first life cycle, we expected deployment to be ramped up as we switch gears from exiting those projects from the first life cycle and then start executing on our strategic investment for the second life cycle. So I just want to create that backdrop in terms of the context of the financial results for the 2025 financial year. So having said that, 4 of the things that I want to start out with is, the first thing is that we would have entered into a new joint venture during the third quarter in Delphine Holdings, where SRF would have acquired 4.9 acres of a property in Trelawney, which represents an 86% ownership stake. And this is zoned for both hospitality and residential. And I'll let David give more details on that, right? So that's a new initiative in terms of that acquisition. I would think that this bodes very well for how we're looking at positioning SRF's portfolio. We would have, second thing I want to highlight is that during this second investment life cycle, started second investment life cycle, would have made new commitments of 2.67 billion, and that is more than double what we would have done in the previous financial year. In keeping, I think we made something like $1 billion of commitment, which was a small figure for SRF during that period. So this is in keeping with what we would have said to investors about deployment of capital. And during the year, we would have exited 2.01 billion. Third thing I want to highlight is the flagship assets and the balance sheet are one of the flagship assets, because very shortly we're going to have 2 other flagship assets coming to the fore as we look at One Belmont in the rear view mirror in terms of execution. So all year we would have been working on behalf of one of the tenants on interior build out for One Belmont, which was completed right at the end of the financial year, and the tenant would have formally moved their head office into One Belmont on September 1st, 2025. All right. And of course, we are continuing to do the work on the part and structuring SRS partial exit from this asset. And I'll let again David provide additional details on what's happening with the One Belmont asset. And of course, finally, but by no means the least, we would have successfully distributed the first dividend for SRF during the financial year of $0.2012 dollars per share. And of course, we'll be looking towards that second, considering that for the board to consider that second dividend payment in like order based on the results for the financial year. Next thing I want to do then is just to again create some perspective in terms of SRF has been in existence for 6 financial years now, and just kind of delve a little bit into, well, what has SRF done in those 6 years from a financial performance point of view. So the way that we look at SRF is in terms of returns are from a return on equity point of view, and the average ROE since inception is 17.5%, which is, I would say a very substantive return on equity. Another way to look at this is to look at the total value to paid in capital, which effectively is looking at the amount, what have we done with the share capital that investors have put into the firm. So investors, would have put in an amount of share capital, and what have we done with that? And what TVPI is saying is that we would have increased the value of the capital invested in the firm by shareholders by 1.82 times. So we have almost doubled it in 6 years, right? So that's another way to look at it. A third way to look at it is, well, what has happened to the book value of the firm, and the book value of the firm is actually at $26.54 at the end of August 2025, which, by the way, is the highest book value of the firm since it became a publicly listed company. So just want to create that kind of context, because SRF is not a REIT. As well, it's not like a development company either. It's a combination of an income generating company whose primary role is to really create capital gains by unlocking value in real estate. And then once we sell those assets, those capital gains get distributed to shareholders. That's what SRF really is about. Total, value of transactions that were exited over the lifespan of SRF is 6.83 billion Jamaican dollars, and all of this, is actually from Jamaican investments, because as we speak, SRF is 100% Jamaican investor. We are a Caribbean firm though, and we intend to double our capital in other Caribbean territories, some of which we are looking at, have been looking at for a little while now, but we haven't executed anything as yet. But I'm sure that we will inform you once we make that decision. Now, in terms of capital that has been deployed, 18.07 billion in 6 years, which is an average 3 billion a year, and on average we exit about $1 billion match per year, if you want to look at it in those terms, from the investment exits and the capital deployed. And final thing, of course, is that earnings per share, which we'll go and delve into a little bit more on the future slides, was $2.34. So all in all, the first year of the new investment life cycle, the metrics and the numbers that we're looking at over the life of the firm has been pretty decent. Now to the financial performance, net profit was up 149.8% to 787.01 million. And this was driven by total investment income, which increased by 92.2% to 1.61 billion Jamaican dollars, up from 839.2 million previous period last year. Net investment income, which strips out operating expenses, is 1.18 billion, up 132.1% from 508.5 million in the previous year. Of course, I spoke about the earnings per share, $2.34 versus 0.96 cents the previous year. And I spoke about the book value per share, up 6.8% at $26.54 versus $24.85 the previous year. Now, the main driver for the performance, or the main drivers, were twofold. One was gain on investment property, which doubled, up 106.0% to 1.08 billion. And this was mainly driven by the increase in the value of one of the flagship assets on the balance sheet, which is Lake Spen. As you recall, that's a 55-acre industrial property, which is nearing construction phase of development. And again, David will provide additional information on that. But we stated more than 2 years ago that as we exit the first investment life cycle and enter the second investment life cycle, there are two flagship assets on the balance sheet that we'll be focusing on. One of them is Lake Spen, and the other one, of course, is Mammy Bay. And at the moment, Lake Spen is pretty much moving apace in terms of the execution of the unlocking of that value. Would have also, the results would have also been impacted by share of gain on joint ventures, which increased by 51% to 748 million. Of course, if you recall, SRF would have increased its ownership stake in One Belmont early on in the financial year from 70% to 86%, and that would have triggered, obviously meant that our share of the JV would increase as that value is unlocked. And of course, we would have also acquired the 86% ownership stake in Delphine Holdings, which is the new asset that I spoke about on the first slide. So these are really the two main drivers of the performance for the financial year. To give you a little more insight on the actual income statement, net interest income, you can see that for the financial year, interest income would have increased, but interest expense would have increased by substantially more and at a faster rate than interest income, resulting in a negative net interest income of 341.56 million versus 202.8 million last year, right? And as we have been saying now for about 5 quarters in a row, there's a timing difference between raising capital and paying interest expense versus deploying that capital into income generating assets on the balance sheet. And this continues apace, which is what resulted in a negative net interest income. One thing I want to highlight on interest expense though is about 1.7 billion of SRF's debt was actually structured as a variable rate debt. And since the Jamaican Central Bank began reducing interest rate at a slow pace, I mean, I would have loved for the pace to be faster. I suspect that given what has transpired with the hurricane, we should expect interest rates to come down at a more substantial pace to support the recovery efforts. But the point I wanted to make here is that the variable rate nature of about 1.6 billion of SRF's debt since April of this year, that would have been triggered, meaning the reduction in rates means that the interest expense cost of about 1.6 billion has started to come down because of that variable portion, the variable nature of that debt. So we should see this filter into the financial statement as we go forward. Another thing I want to highlight here is that there is a loss on sale of real estate asset at 84.9 million. That's on the face of the income statement. However, this does not represent a loss on actually selling any of the assets that we have, right? If you recall, we would have exited a few assets during the course of the financial year. We sold all of these assets, you know, at a pretty decent level above where we bought them. However, based on accounting rules, there's a timing difference between when we recognize certain parts of those transactions in the financial statement. And depending on when you recognize it, it shows up as a loss based on the carrying value. But it's not an actual loss in terms of losing money on the exit. What else do I want to highlight here? I also want to show total operating expenses would have increased from 330 million to 432 million. But the main driver of this increase, of course, remember that the management fees were reduced to 1% in the financial year 2024, and then from 2%, and then they would have gone to 1.25% from 1% in the prior year. So that little 25 basis point increase would have contributed somewhat to the increase that you saw there, as well as, of course, audit fees, etc. Just want to highlight that because the company is paying management fees based on assets under management, and assets under management was increasing, then obviously operating expenses went up. Final point I want to highlight here is fair value loss that goes through the income statement, and this fair value loss was driven by basically real estate investment notes, REINs, third-party REINs that we have put into receivership, and we are going through. Well, we have put them. They are non-performing assets, and we are going through the process of calling on those collateral to get back our monies. And so, based on the nature of these notes, which were kind of profit sharing notes, we have marked to market what we think is the fair value of those assets, which if upon exit, depending on what the value is that we get back, can be lower or higher depending on where it is. But at the moment, this is where we see these assets being marked, and so we have marked them and now we are carrying them. Obviously, the underlying assets, real estate, development, and land, etc., is what we will call on to try and recover all of our monies. So I wanted to highlight those specific items, notwithstanding the level of profitability that would have been made in the year. Now moving more quickly to the balance sheet, shareholders' equity, 9.21 billion, up 13.5% versus last year. Last year's 8.12 billion, and total assets 17.04 billion, up 7.5% from the 15.85 billion previous year. Again, trying to focus investors, and when we say value, what do we mean? Well, shareholders paid in capital was 5.1 billion, and the return that what we have done with that 5.1 billion, we have increased it by 1.82 times to bring that value now to 9.28 billion, right? And what this really means is, okay, if we were to sell off all the assets on the balance sheet, ceteris paribus, and repay all the debt, what's the value that would remain in the hands of shareholders? And that's how we look at value creation cycle for SYGNUS Real Estate Finance. Of course, one of the actions that would have taken the company would have taken during the year is, if you recall, it would have done a debt for equity swap where 377.91 million was of liability was swapped into shares, which was which actually went to the manager SYGNUS Capital Limited. Well, SYGNUS Capital Group is actually the holder of those shares, which is now the second largest shareholder. And so, we have full confidence and belief in the growth prospects of the company, which is why we would have effectively swapped cash for shares, because the only way that the manager can unlock that value is if we deliver the value in the performance of the company on a go-forward basis. So the shareholders' value is aligned with the value that the manager is trying to extract. From how the company is being run, efficiency and management expense ratio, all of these are well within target threshold levels. Again, management expense ratio, and efficiency ratio, we're looking at for every dollar of, well, from management expense ratio point of view, what percentage of assets under management goes out into expenses, and we are saying that, keeping international best practice, this should not be greater than 3.5%. And as you can see, this came in at 2.5% for the financial year, and you can see that we haven't really been that close to 3.5% over the last 3 financial years. From an efficiency ratio point of view, that's looking at the same thing through a different lens, which is for every dollar of revenue that's generated, how much of that goes out to pay expenses. You can see that we were above the threshold limit of 45% 2 years ago, when we were kind of ending the last investment cycle. We're overlapping with the start of the current. But you can see that for this financial year, when we started the new investment cycle proper, we came in at 26.8%, which is a much more efficient use of every dollar of revenue spent. So just looking from a portfolio activity point of view, very briefly, real estate investment assets would have increased to 16.63 billion from 14.7 billion last year, and this was comprised of 10.73 billion in total property investments, up from 9.26 billion last year, and 1.89 billion in real estate investment notes, slightly higher than 1.86 billion in 2024. Of course, this would have been partially impacted by the fact that we would have had 2 assets that are in receivership, and then joint ventures of 4.01 billion, substantially higher than 2.03 billion in the previous year, and this would have been affected by the increased stake in One Belmont joint venture, as well as the new Delvin Holdings joint venture. And finally, we spoke about it, the doubling of near doubling of exits relative to the previous year, coming in at 2.01 billion. From an investment allocation point of view, there aren't any substantial changes here, so I won't spend a lot of time here, save and except to say that you can see that we are diversified by investment, real estate investment category, but from looking at this from a more broader broader perspective, you can see that investment property still makes up the majority of the assets on the balance sheet, coming in at 61.8%. Previously, this would have been in previous time probably 73, 74%. So it is being rebalanced slowly but surely, right? And you would see that joint ventures now represent 24.1%. And we would have indicated on many occasions that utilization of joint ventures is one of the methods through which SRF will pursue unlocking value rather than buying property outright, because this, gives us more flexibility in terms of use of our cash. So now just switching gears and looking at summary of key strategic assets. You can see on the balance sheet where all the assets that we have on the balance sheet. There are a few changes. You can see Delvin Holdings, which is the new JV. Of course, 5658 LMR Limited, as we would have explained during the course of the financial year in prior earnings calls, that effectively we would have repurposed 5658 LMR Limited, which previously actually would have held the properties at 56 Lady Musgrave Road and 58 Lady Musgrave Road that we sold, to now hold a residential property in Puerto Rico and St at Landfall, and that's a 71% joint venture. And of course, we would have sold Charlie Main and Hillcrest, etc. In prior periods. So I want to now turn over to David to give his thoughts on the various assets that we have on the balance sheet.
Thanks, Jason, and good morning, everyone. So with respect to our Class A One Belmont building, and notice that I'm starting to refer to it as a building and not just a project. We now have 2 tenants occupying their floors, and we can state that we have 2 more floors that will commence their fit-out works in the coming weeks for an estimated occupancy sometime in the summer of 2026. We have an excellent property management team engaged, and we continue to work with them, of course, to close out the last few remaining building related matters, as you see indicated here in terms of any defects and so on. So all good as far as One Belmont is concerned. Next slide, please. With respect to our 14-acre Miami Bay flagship property, as Jason would have alluded to, and as you can see on the screen, we are continuing to make excellent progress as we advance towards a decision phase. As you can tell, the site is ideally located for residential and or hospitality investments or developments. And we are continuing to be in the midst of several ongoing discussions, which once they begin to crystallize and a decision is made by the investment manager, of course, we'll update you on the plans to roll out the value unlocking for Miami Bay. Next slide is our 55-acre Lakespen Flagship 2, I refer to it as, property. And this is pretty much on the cusp of the regulatory approval process, which means that we remain on target for construction to start at the beginning of 2026. Now, in order to enable this construction to commence, we have already executed the construction contract with the main contractor. And of course, we are increasingly confident surrounding the value proposition, the unique value proposition that we are bringing to the industrial market with this particular project. And the final slide is with respect to Delphin Holdings. And as Jason alluded to earlier, our latest joint venture, Delphin Holdings, is pretty much centered on a fantastic 4.88 acre property in Trelawney. Beautiful beach it is. And we are currently in the midst of reviewing quite a few design development options in both residential and hospitality spaces. So we can unlock the optimal value of this particular property. And once we are at the decision phase with the investment manager in terms of the process to unlock the value, we'll be in a position to update you accordingly. But you can look forward to, once again, we will be doing this in the optimal way, because as you can see, it's white sand beach, beautiful location, and we will be unlocking the optimal value of this particular property here. So that's it from me. Thanks very much. And I'll hand you now back to Jason.
Thanks so much, David. So all that remains now is for us to give you some insights on, strategic initiatives. So the first thing here is, as we have been saying very consistently for maybe 3 years now, is just execute our key strategic initiatives. So for One Belmont, they will have gone through what that is in terms of, tenant occupancy and build out, etc. And of course, we continue to structure the partial exit. I know that these things seem as if they're taking forever, but when you're doing real estate, you have to do it properly. It's a patient man's game, a woman, right? And so that we are patiently structuring the partial exit, and of course, shareholders and prospective investors will be invited to participate in that exit, as I would have stated many moons ago, that will afford an opportunity for shareholders and other investors to participate in that One Belmont exit. So basically, SRF partial exit, and you will get an opportunity to partially hold that asset, right? So when that time comes, we'll inform you. David already spoke about Miami Bay and Lakespen in terms of value creation process, and that remains on track and in train. And of course, we continuously are trying to deepen access to flexible capital in the real estate space. And the way how we do this is by all the joint ventures that you see, that's what we are doing, right? People have valuable land. We go in, we lend our expertise and capital and work as a partnership to create something wonderful and beautiful that will remain on the landscape, hopefully for a very, very long time. So those co-developments and JVs are going that way. And we also do so via real estate investment notes, and we have a few that have already been approved and for capital to be deployed to increase our exposure to income generating assets. We have spoken about, would have realigned the portfolio somewhat over the past 2 years, and we continue to do so. You'd have seen we would have sold some properties that we got very good value for, and then taken that cash and redeployed it into other assets that we think can give us a good bang for the buck, so to speak. Investment life cycle overlap. We already spoke about this, that we had a temporary 2-year reduction. So we signaled that we were going to do this, and the 2 years have elapsed and we did it. And pretty much everything that we promised is what we have delivered on over that 2 years, right? With the culmination of the 2025 year-end financial performance that you are seeing. What we still have to do is the work and the asset workouts from the third-party REITs. Of course, as I said before, these are going through the process. The process is a long process. As I said, real estate is a patient man's game, or a patient person game. And so we are patiently working through those asset exits appropriately with receivers, etc., as the case may be. Now, the second thing that we're looking to do here, is to expand our footprint into other Caribbean countries, and we are continue to evaluate multiple high-value opportunities, and at the appropriate time, like I said before, we'll take that exposure. There are opportunities in the Cayman Islands, with people showing us stuff from Guyana, Belize, St. Lucia, St. Vincent, all over the Caribbean. But given how patient we are, at the appropriate time, we will take the right opportunity that is right to create the value for our SRF. So we're still going through that evaluation exercise, but rest assured that we will take the decision at the right time. Dry powder, basically, more of the same. I think we would have raised 4.11 billion or thereabouts over the last 18 months or thereabouts. About 1.6 billion of that would have come in during the just concluded financial year, and we would have spoken about the 2 billion of exits that we would have done. So in combination, that's a substantial amount of dry powder that we would have been able to utilize and tap. And we do have additional exits that we are going through at the moment that will add to this recycling of capital. So that's one. And as usual, we have our normal capital raises that we'll do at the appropriate time to fund whatever transaction we have that we need to fund. And these include credit lines as well as private placements that we'll do from time to time for individual projects. So we do have individual projects now that capital is flowing from investors directly into those projects versus capital that goes into SRF itself as a company. So I just want to highlight that fact, right? SRF has multiple subsidiaries that hold individual assets, and we can finance those on a standalone basis, or we can finance them through the parent. So we continue to do this while we try to unlock the value and increase shareholder value. And finally, but by no means least, obviously the company will look to consider a second dividend payment based on the just concluded financial results. And that announcement will come, I guess, in short order. Thank you very much. I think we'll now take questions.
Thank you so much, Jason and David, for the presentation. And yes, as Jason would have said, we are going to segue into the questions. If you have not already submitted your question, feel free to do so using the Q&A feature in the Teams platform, or you may even send them via email. We do have a few, so we will get started. You would have mentioned advancing the design phase for Lakespen and Miami Bay. Given the regulatory timelines and the capital intensity, how confident are you about breaking ground on Lakespen in the calendar year 2026, and what contingencies are in place if the approvals take longer?
So that's an excellent question. And our confidence is based on clearly close liaison with the regulatory authorities, timely feedback that we have received from those authorities, that that's essentially the bedrock of our confidence. It's just based on timely feedback that we've been receiving, as far as where it is along the process. Clearly we know the process quite well in terms of the agencies that need to give responses: NWA, NWC, JPS, NEPA, Paris Council, etc., and so on. So essentially our confidence is based on the timely feedback that we have been receiving from the regulatory authorities. In terms of contingency, should it drag, if we are by some small probability do not receive regulatory approval early in 2026, then that would represent a shift of the timeline of the project by how many months the approvals slip by. The main impact that would be clearly on any time valid returns, which the fund manager can speak to. But in terms of our execution, it really would just impact the date by which the contractor would mobilize on site. The contract has already been executed with the contractor, so it's just a matter of us giving them the appropriate mobilization notice once we receive the approval in hand from the St. Catherine Municipal Corporation. So I hope that answers your question.
Thank you, David.
In other words, we are very, very confident and we have a contingency.
All right, thanks, Jason. Thanks, David. All right, so this next question is in relation to Hurricane Melissa. Does the passage of Hurricane Melissa present any emerging risks or headwinds for SRF at the portfolio level as well as at the project level? So perhaps, Jason, you could take portfolio level, and David, you could take project level.
Yeah, well, I mean, at the portfolio level, to be honest, based on the type of assets that we have, we don't really see any, we don't have any material, nothing devastating happening to any of our assets on balance sheet. So that's one, and David can perhaps give more insight there. But I guess there are two effects that's gonna start playing out in terms of the market itself. In terms of, obviously, there's gonna be a tremendous demand for housing in the western side of the island, right? And there's also gonna be a tremendous demand for rebuilding of various types of assets in that side of the island, given the destruction that would have taken place. And of course, there are opportunities there for SRF, given the expertise that the team has, to perhaps lend support to some of those, if it makes sense for us to do that. But from a portfolio point of view, we're not seeing any big negative things that are happening just based on where our assets are located and the type of assets that we have on the balance sheet. I don't know, David, if you have any thoughts.
Yes, thanks, Jason. I'll go down to the project level. Clearly, real estate and construction, the input factors, labor and material. Yeah? So, with the massive reconstruction effort that's going to be required in the western third of the island, and it's early days now. So clearly we're not here trying to make any predictions. We're just giving some initial thoughts around what things, the main considerations. Clearly having enough labor on hand, appropriately skilled labor to undertake the massive reconstruction out west is going to be something that has to be considered. The supply chain and any bottlenecks in it to get all the new material in for the rebuilding. Clearly, the method of rebuilding has to be thought through. We want to ensure that we are building back in a resilient way. So we may have to get innovative and not just build back what was there before. So there's going to be a lot of opportunity for innovation, new methods to ensure that we build in, resilience. So those are the main things I think that will have to be considered: labor, material, supply chain bottlenecks, and of course, just how we reimagine the rebuilding of Jamaica for a more sustainable and resilient future. Yeah?
Thank you, David, and thanks, Jason. Now, next question is in relation to dry powder. The MD&A noted 63 million in dry powder at year end versus 900 million last year. With that reduction, how do you plan to maintain flexibility for opportunistic acquisitions while funding ongoing developments?
Thanks for that question. I thought I had answered it before, so let me repeat it. So SRF has multiple subsidiaries, right? And in many instances, the financing for some of the projects that we have will be done at the subsidiary level. In other instances, SRF will raise the capital as appropriate and fund. We also have, credit lines that we can access and draw on as we need. And we also have our normal capital raising program where we raise capital as appropriate based on the timing need for funding to deploy into projects. So it's a multiplicity of approaches, which is what we have done over the last 6 years. So for example, last year you saw we raised a lot of capital via private placements. We'd also seen maybe over the last 18 months where we sold our exited assets and for substantial amounts, and that represents obviously capital that we use, for example, to put into the new joint venture Delphin Holdings. That was a combination of cash that we use from selling or exiting one asset or one project, and then redeploying that into a different new project. So it all depends on the timing of the various needs. We obviously work with a plan that has a pretty advanced timeline as to we need capital to be deployed into X project or X asset. We raise that capital at X minus T time, either in SRF itself, which show up on SRF balance sheet, or within the project itself into the subsidiary, as the case may be. So the plan doesn't really change. The plan remains as we have always done, which is raise the capital at the appropriate time, rather than raise the capital too early and then it becomes a drag on the income statement with higher interest expense costs. So we don't want to do that. We raise it in a timely manner as close as possible to when it's needed. I hope
Thank you.
I have answered the question. Yeah.
Thanks, Jason. Next question is in relation to the fair value losses, which you did touch on a little bit. So the fair value losses on the investment notes would have increased this year. Can you provide more color on the workout process for these distressed notes and whether you anticipate further write-downs before recovery?
So at the moment, we're not really expecting further write-downs. I think we have done a pretty good job of assessing kind of the close to worst case scenario type of thing. But one never knows in the future, right? So the way this works is that we have, you know, receivers, a receiver working through the normal process. If you recall, one of the assets, there were deposits that investors, our depositors had made with the developer of the project. And as part of our process, we normally request and require that these deposits are held in escrow and are not touched by developers. So because we took that route, because we required that to be done, then when the project got stalled, we then, because we would normally have a lien, have a lien on the account that has the cash in it, then we would have authorized for those deposits to be returned to those depositors, of course, along with the real estate board giving its go ahead. And that then meant that the asset becomes free and clear for us to then step in and start pursuing the workout process with a receiver to recover the money that we put in the project. So, like I said before, that's a process that's ongoing, and we hope that this process is concluded in a reasonable amount of time. We have other assets where the project is finished, and so there are sales that are going on. I think up to maybe a week or two ago, a sale would have come through. So sales are going on, and when those cash come in from the sales, then obviously, you know, it's gonna be used to help reduce the liabilities that the project has, and of course, you know, we would have been the lender or investor in the project. So the process is well structured and well managed. It's just a matter of allowing the process to work and for time to pass. But the two projects are the two assets that third-party assets that have challenges. They are different levels, are different stages of being worked out. One of them is almost closer to completion than the other because sales of units are ongoing and going well, and the other one has a longer lead time for the workout process to conclude for us to get back the capital that was invested. Hope I've answered the question. If not, you can ask follow.
Thank you, Jason. So the next question is in relation to the net interest income. What are the plans to improve the negative net interest income, apologies, in the 2026 financial year?
A good question. So we would have kind of spoken to this from like this first quarter of the financial year, which is to deploy substantially more capital into third-party REINs and income-generating assets. During the course of the year, what would have happened is, as is norm, right, with real estate, many of these projects would have been delayed, and the deployment of capital with REINs in 99% of the times it's a drawdown schedule that you have to work with, right? So if there's $100 that need to go into a REIN, you don't provide $100 on day one. It's gonna be okay. Work is done, they submit an invoice that's approved, and then there's a drawdown for $6, mobilization, and then you have $10 and then $3, and as the contracts, as the works are approved, we supply the cash, and that's how the drawdown works. So it takes a while. Now, if the way how we funded that is we went out and raised capital, and we raised $100 for simplicity on day one, because we know that we need to fund this project for $100, but the drawdown takes place over a year or 18 months or 15 months, then you can see that we're gonna have a negative from a interest income point of view, which is receiving income on the $6 drawdown first, then the 8, then the 10, then the 10, then the 15, and 20, while we are paying interest expense on the $100 from day one, right? And so that's what I'm referencing. So our job there is to substantially increase the deployment of cash capital into REINs, and we do have quite a number of approved transactions on the balance sheet, but some of those were delayed, in the last concluded financial year. We expect a higher run rate of deployment in the upcoming financial year, one, to close down that gap, and two, as I said before, part of the funding that we have is structured as variable rate, and so as rates come down, that variable rate portion will reduce interest expense. And then thirdly, any new capital that we are raising, for example, maturing debt that, let's say, we replace with new debt, we expect to do that at a cheaper cost of financing. And so a combination of all of those three things, we expect to narrow the gap between and the negative interest income, that your net interest income that you're seeing. And finally, as we get into exiting closer to the back end of the financial year, where we exit an asset, then the debt that we use to fund that asset will normally exit at the same time, and in so doing, we reduce the size of the liabilities in a case like that. So there are multiple approaches to doing so, but I wouldn't expect this number to turn into a positive number in one financial year, like in 2026, but I would expect that the gap would be closed.
Thanks, Jason. All right, so the next question is in relation to One Belmont. You mentioned tenants are currently occupying the building and that some are completing build-outs, but are there any floors available for lease currently?
So the way go ahead, David.
So not at this moment. There are only 5 floors. So although you drive past and it's a very large building with 80,000 square feet and a further 160,000 square feet of parking, there's really only 5 floors, and of which one tenant is taking 2 floors. So really there's only 4 occupants of the building. That just should give a bit of color. It's not a typical sort of retail framework that we've used here. It's pretty much one tenant per floor, which is about 16,000 square feet. So I hope that gives a bit of color as to where we are now.
Jason, would you like to add? I see that you're unmuted.
No, I've been unmuted the entire time. I'm fine.
All right. Thank you, David. All right. I believe we have covered one more question. So the first dividend was paid last year. Should investors expect a regular dividend going forward, and how will this align with the reinvestment needs for the business?
That's a very good question. So, on the first part of the question, we expect effectively, the way we look at SRF is we expect a moment, a kind of an annual dividend payment, and that's just based on the nature, the lumpiness of how SRF generates revenues. And so, for example, when we do, let's say, a one Belmont exit, there's a big lump of cash that is likely to come in, and then we have to wait until, okay, once we execute on Lake Spend and start the exit process, then lumps of cash come in again, etc., etc. And because of that, that's the reason why we are not, like, for example, a semi-annual or quarterly paying dividend company at the moment. Of course, part of SRF plan is to substantially enhance the income generation portion of the business, and we are working on that, but we're not at the stage yet where that will come to fruition, because part of that, for example, and I hinted at this maybe a year and a half ago, which, for example, SRF can exit its holding of Belmont proper, but then utilize a different vehicle to have Belmont as an income generating asset on the balance sheet, or as SRF as an investor in that, along with other investors. So we're still working on that. And there is an opportunity for us to put more than one project that SRF itself would have developed and executed and got tenants to occupy and generate this income, and have that holding as income generating assets that SRF then is an investor in, along with other investors, versus how the asset is being carried on the balance sheet. But like I said, we are maybe a year or so away from executing on that portion of the plan. And once that comes to fruition, then that would allow SRF to be a more frequent payer dividend, because currently the way that the business is structured, which is primarily overwhelmingly to generate capital gains from exits don't happen every quarter, every 6 months, right? They kind of happen on a schedule that's more aligned with an annual frequency. And so that's what our plan is at the moment. And if this changes, obviously, as we normally do, is provide an update to shareholders in a call such as this.
Okay, thank you so much, Jason. So we are now at the end of our earnings call session. We would like to extend a big thank you to everyone who attended our session today. As a reminder, we are encouraging you to read the published audited financial statements for the year ended August 31, 2025, as well as the management discussion and analysis. Both sets of documents can be located on the Jamaica Stock Exchange website, as well as the investor relations section of SYGNUS Group's website, which is www.sygnusgroup.com. In addition to that, a recording of the earnings call and a copy of the presentation will be made available later today on the investor relations section of our website. Thank you for joining and have a good day.